Hello, how are you doing today? Today, I want to talk a little bit about some of the ways that we as investors could do well, regardless of what happens with the political environment. I always talk about how you can't control what Washington does, but you control your own actions very easily. At least we try to control it very easily. So, I'm going to be talking today about three concepts on how to do well in this environment. How to do well with growing money and protecting the money. And I'm really giving you a little bit of a sneak preview of new content that's going to be in my book. And really, what I'm talking about in the book is that you have to step away from the herd in order to be successful. Because in today's environment, Wall Street is packaging tons of products for people to invest in. And many people, I would say 80% of the people out there are investing this way, where they're buying packaged products that basically own everything or close to everything in a particular asset class. And they tend to be relatively static. And what I'm going to be talking about is how what we really need to do is to basically, we need to step away from the herd and actually differentiate what we own rather than just owning everything. And I'm going to talk about a few tools that I've found to be very helpful to do that. And this will be a relatively short video, so you might want to get your pen handy if you're want to have this information and understand a little bit about it. So the first thing is, how do we eliminate the stocks in particular that we want to own? And I have what I've developed called an ADP criteria. And ADP is an acronym that stands for adaptability, desirability, and profitability. So when we're looking at companies, we really want to find those companies that have the ability to adapt to changes in technology and innovation. Because the basic thesis that I have is that because we have several big tailwinds that are happening, or I'm sorry, headwinds that are happening in the economy, uh, high government debt, lots of overhang from that, and issues with COVID and many other things. But basically, we have governments that are spending a lot of money and printing a lot of money. That's creating headwinds in the economy longer term. And we want to be in a position where we are winning, because even though we have these headwinds that are happening, the tailwind that we have, the big tailwind that is huge for us as investors, is the rapid innovation and the rapid technological advancements that are literally hitting the entire economy. So the adaptability stands for, hey, look, these companies need to be able to adapt to change and technology and innovation. If it's a stodgy old company that is unable to adapt, then you really don't want that as a company to focus in on. Desirability of product and service. The D stands for desirability. You really want the company to have a product or services that is in high demand, that is desirable now and also in the future. There's a lot of products that used to be desirable that are no longer available. And if their company is not adapting to the new desirable product lines that customers want, you're really not going to have a good investment. And the last is profitability. There are companies out there that are young and aggressive and that have a new product that's doing well. But if you look at the business model, even though they're able to sell a lot of units, their business model is so expensive, they're really not going to be able to break into high profitability, because ultimately, as stock investors, we need to have profits there. So that's the ADP criteria: adaptability, desirability, and profitability. And that's going to allow you to whittle down those stocks that may not make a whole lot of sense, and to stay in those, focus your capital in those that do make sense. Now, once you've done that, within that, there's a formula that I love to use. And I'm really big on formulas because they're like checklists, and they help you make sure that you're looking at the investment consistently. And I have this formula. It's called I call it the stock selection formula. It's 3P plus 3C plus SA. Now, so you have 3Ps and 3Cs, and then you have this SA. So what this formula does is it talks about what to invest in or which stocks to invest in, further drilling down from the ADP criteria. And it also talks about how to trade it, because both those decisions, what to invest in and how to trade it, are very, very important. They're equally important. So let's talk a little bit about the elements that are that should determine what to invest in that we like to see. The C's, the three C's are the customers. Are the customers doing well? Are the customers not doing well? Are they growing? Can they pay a higher price? Do they want to pay a higher price? So C for customers. And then the second would be competition. So do they have a competitive advantage? Or do they have something really unique that's standing out? And then the last part of the C's is the costs. Are their costs wild and crazy? Are they able to contain those costs? What does that look like? So there's the three C's. Now the three P's are more about the people. How good is the management team? Are they making smart choices with the capital of the company? Are they running operations well? It's about their position. And here I'm talking about their financial position, meaning do they have good cash on the balance sheet? Do they have manageable debt? Those are really important because if you have a big economic decline, if their financial position is not strong, then they may not do well and you could lose a lot of money. And then the last is really important. It's performance. And there I'm talking about the supply and demand of the stock itself. We really want to see a healthy stock price pattern. And within that element, I've got a whole nother kind of acronym I call TORQ, T-O-R-Q, that explains exactly what are the elements are to look at for price performance, how the stock is doing. Okay, so we've talked about what to invest in, customers, costs, competition, people, position, and performance, right? Now let's talk about how to trade it. There's two elements, S and A. S stands for safeguard. So safeguard means basically rule number one is protect capital. So there's two big parts to this. This can be broken down, but the two biggest parts have to do with position size, which is how much you invest in a particular investment. And you want to have that relative to the risk. So the larger the risk, the lower you invest in. The higher the risk, the smaller the risk, the more you can put into it. The second has to do with diversification. You don't want to have a lot of investments with overlapping fundamentals. You want to have fundamentals that are different so that the drivers of revenue and costs are not the same. That gives you more of a smooth ride, and with that, still keeping that high return. So that's how you safeguard your investments, through your diversification and through your safeguarding, through your position sizing. The second part of that is asymmetry. Now that's a fancy word. Asymmetry means that one side is bigger than the other. It's asymmetric. It's not. That's really what you want when you invest. You want your profits, your winning investments to be larger. You want to make more money when you're right, and you want to lose less money when you're wrong. That's the asymmetry. And it's a real basic concept, and you can get pretty technical on how you actually implement it. But the basic concept is when you have something that is actually winning, you can verify that you're winning with this particular stock, and all the fundamentals stay in place. You need to hold on to those winners. It's a real common thing to want to sell those winners too soon. But in order to get asymmetry, you have to let those winners run. And on the flip side of that, and this is the hard part for a lot of people, is you have to cut your losers short. When you have something that's not working out, and I don't care how great your fundamentals are, how well you know the stock or the company, if you are having something working against you, it's important to cut those losses. So, and that gives you the asymmetry. You can always get back into a stock. Now, this is something I learned from William O'Neill back in the day, but it's a very important concept that cut your losers. And this is a statistical way for you to get asymmetry in your payoff. So that's really it. Those are the things that these two tools are very, very valuable to win, regardless who's the president, regardless of what's going on in the economy. Because if you're using these concepts, even if you get into a bear market, you will be paring back from your positions, and you could literally be into cash. And when things are really ripping and roaring, you'll be buying those companies and holding on to those winners, and you'll be kind of paring back on your garden there and letting the ones that are growing really continue to sprout and grow. So let me talk a little bit. I have a little bit of time. I have about a minute here on performance. Now, this concept, TORQ, that has this TORQ. That is how I like to look at the stock performance. And it's basically, what is the trend? Is the stock overextended or not? You don't want to buy them when they're overextended. What is the relative strength? Is it outperforming the market or not? So if it's outperforming, that's good. And then patterns. We like to see the psychology of the patterns, which is a whole nother topic. But the patterns themselves should be quality patterns. So trend, overbought, oversold, relative strength, and quality patterns. And that whole formula, when you put that together, that gives you a very high likelihood that you will do well. That's all for now. Hope you're having a great day. Talk to you later.